So we finally got the long-awaited answer to who is going to replace Jerome Powell as chairman of the Fed when his term is up. President Trump recently announced that his choice is Kevin Warsh. So as the Fed enters this transitional period in more ways than one, I thought now would be a good time to create a video on how the Fed impacts equity markets. So we're going to walk through the Fed's mandate, the cycle of monetary policy, the impact they have on interest rates, and then we at the Macro Institute did an analysis specifically on previous cutting and hiking cycles, and we'll show you what the impact on the stock market was from those choices. So we're going to start here with this graphic on the left real quick. A lot of you probably know, but the Fed has a mandate. It is often called a dual mandate because they're worried about two things. They want to keep the economy as close to full employment as possible, and they want to keep stable price increases. So they're looking to target an inflation rate of 2%. Now, the Fed actually has a lot of tools to execute its mandate. However, we're only going to talk about number one in this video, open market operations. That's the one most people think of, but we do cover all of their tools in depth. So even the ones beyond these that I list here in our full macro specialist designation program. So if you're looking for more in-depth coverage, a full coverage of all the tools they have, I suggest you check it out. But yes, in this video, we're only going to focus on number one, open market operations. What that means is effectively, it's the Fed adjusting the federal funds rate. I think a good way to think about this is that they anchor it to inflation. Now, I know they have a second side of the mandate, which I will talk about. But generally speaking, as you can see from this chart here on the left, when inflation rises, the Fed is often going to raise the federal funds rate, not just often, basically every single time, in order to try to fight off inflation. And then on the flip side, when inflation is falling and becoming less of a concern, at that point, the Fed is generally more worried about the labor market, so they will decrease the federal funds rate alongside cooling inflation. And you can see this here in this cycle. So the cycle of monetary policy. We're going to start in the top left. So the Fed cuts rates. At that point, proxies of growth like LEIs tend to rise. Earnings rebound. GDP accelerates. As you can see, there's some lags between years and months. Employment tends to rise. So as GDP is rising, growth is rising, optimism is rising. Companies start hiring more and more people. Inflation then slowly starts to rise. So it's a balance. The employment market's getting better, but inflation is starting to rise. Eventually, inflation is going to get so high that the Fed decides to tighten policy. So now we move down to the bottom row. So here they're starting to raise the federal funds rate, and you basically see the opposite happen in a very similar timeline. So LEIs, or proxies of growth, will peak, earnings will decline, GDP will decelerate, companies start to feel worse, growth is slowing or it's contracting, and so they're not hiring as many people. So employment falls or the unemployment rate rises, and inflation starts to fade. So at that point, the Fed's more worried about employment, they're less worried about inflation because it's fading, and that's generally when you'll see the Fed starting to cut rates again. And around and around and around we go in this cycle. So the Fed has a big impact on interest rates, specifically on short-term rates. So short rates and the federal funds rate are strongly correlated, as you can see from this chart. You can basically use different versions of short-term rates interchangeably when you're trying to forecast economic data, because again, they flow basically in the same direction. You can see there's a very, very tight relationship here. And you can see that all the way from 3 months to 2 years, right? So there's a decent spread there. However, when we zoom out, it gets a little bit more complicated. So the further you get away from the federal funds rate in terms of the yield curve, the less control the Fed has on rates. So on longer term rates, it's a much more complicated relationship. I've circled a few areas. That's not to say the Fed does not have any control on long-term rates, but there's a lot of other factors. Some also include the Fed, so the Fed's own credibility, the fiscal situation of a certain country. We're obviously talking about the US here recently. As you can see on the right, the Fed has had very little control in its most recent cutting cycle over the 10-year yield. It has actually been flat, and recently it's been rising as the fiscal situation, political uncertainty, global economic uncertainty, the value of the dollar has fallen. So there's a lot of reasons why investors on the long end of the curve have been demanding higher rates to borrow from the US, even though the Fed has been cutting the federal funds rate. So that's it on rates. Basically, the two things to remember: short-term rates, the Fed has big control over. By moving the federal funds rate, they can generally control the short end of the curve. Some of that control goes away as you go further and further out on the curve. There are other components that affect longer term yields beyond the Fed. So they're just a small part of the picture. And now we're going to get into equity markets. So I have three really cool charts based on some analysis we did here at the Macro Institute. We looked at some of the previous rate cutting and rate hiking cycles. So in this chart here, this is the S&P performance in the 12 months after the first Fed rate cut of a cutting cycle. So we have 5 different instances here, as well as the average. And so what gets a little confusing, I think, for some people, because you have politicians a lot of the time calling for rate cuts. So you would imagine that, the equity market would respond well. But important thing to remember is that the Fed is generally cutting rates when things are going poorly. So if you go back to that cycle graph that we talked about, the Fed's cutting rates when the employment market is not doing well. The unemployment market is rising, inflation is falling, growth has sputtered. So rates are getting cut in order to stimulate the economy. And so you can see from these equity returns here, there's really a mixed bag. So in the 12 months after the initial Fed rate cut of a cycle, the average return across these 5 instances that we looked at was just plus 1%. And you can see 3 of them were positive, but 2 of them were really, really negative, 16% down in each instance. Now, obviously, each of these cycles has their own unique traits. But this is just to say, it takes a long time for rate cuts to work their way through an economy. So at the time that a Fed starts to cut rates, it's important to remember things aren't going well, and it's going to take a while for those rate cuts to flow through. Now, on the flip side, rate hikes, right? If you listen to politicians and sometimes the media, you would think that it's totally a negative thing. But in fact, not only has the S&P been rising into Fed's initial rate hike, right? So the market's not scared of incoming rate hikes because, again, if you think about the cycle, when is the Fed hiking rates? The Fed is hiking rates when unemployment is low and inflation is just starting to rise. So people are happy, the economy's chugging along, and as inflation starts to tick up, that's when you start to see rates being hiked. And so if you look at this, again, we looked at these same period, not the same periods, we looked at hike periods. The number of trading days before and after the Fed's initial rate hike. So this is the opposite of the last chart. You can see the S&P rose into the hike, and then while it was flat for a while, right after the hike, if you look, it looks about 80-ish days. It stays relatively flat, maybe a little bit negative. It actually then continues to rise. So again, right now, based on what politicians say, you might think that rate cuts are going to be this big boom for the stock market and rate hikes send the stock market lower. That is not really the case if you look back through history. And a lot of that has to do with the timing of when the Fed is cutting versus when the Fed is hiking rates. And now last chart, this one is really interesting and cool. I wouldn't draw too much of it, but just because we're about to have, or we just had our Fed chairman nomination. So we also looked at the stock market changes following and leading up to the announcement of when the next Fed chairman or chairwoman, in the case of Janet Yellen. And you could see the market generally rises. Now, we're not really sure why that happens, but I have a good guess. And the stock market hates uncertainty. And so knowing who's going to be next, because again, these people generally serve pretty long terms, and so you know who you're going to be stuck with, the market feels good about that. It can start to discount who's going to be in charge. What's interesting this time, though, is as I'm recording this, I'm a little scarred because of our last gold video. I recorded a gold video rising, and then by the time it got posted, gold price had completely collapsed. So this number is going to be very different, but at the time of recording this, which is Thursday morning, the S&P is down about 2.5% since the announcement of Kevin Warsh. Now, I'm not going to draw conclusions from this. Obviously, it's only been, I think, 5, 6, 7 days. So we have a long way to go for it to be added to this chart and seeing the full picture. However, it is bucking the trend a little bit, where generally you see some sort of small rally after the announcement of a new chairman's nomination. So I don't think there's anything to draw from that. Very small data point, but something interesting to mention nonetheless. So I hope you enjoyed this video. I hope you learned something new. If you did, I would really appreciate it if you could take a second to like the video and subscribe to our channel. Have a great week, and I will see you back here next Monday for another educational video.